The Little Book of Valuation by Aswath Damodaran. Ever stare at a stock price and think, how did they come up with that number? It's like someone pulled it out of a hat, right? We're told investing is this mysterious game for the experts, too complicated for regular folks like us. Oscar Wilde once said we're cynics who know the price of everything but the value of nothing. Ouch. Here's the thing, though. Every price tells a story. A story about money flowing in and out, about companies growing or stumbling, about the risks we're all taking. And learning to read that story? It's one of the most powerful skills you can develop. No joke. Today, we're diving into a tiny book that packs a serious punch. It's called The Little Book of Valuation, written by Professor Aswath Damodaran, who people literally call the master of valuation. But don't worry. This isn't some sleep-inducing textbook. Think of it more like a secret decoder ring that unlocks how companies get their price tags, how investors pick winners, and how some people build actual fortunes. Damodaran has this refreshing take. Valuation isn't rocket science. It's not some exclusive club for Wall Street types in fancy suits. It's a skill, a craft, that anyone curious enough can learn. So here's my promise. By the end of this episode, you'll understand the two main ways to think about value. You'll have the essential tools of the trade, and you'll see how to use them on any company, whether it's a scrappy startup with big dreams or a corporate giant that's been around since your grandparents were kids. We're going to pull back the curtain and show you that value is way more than just a number. It's actually the beating heart of how business really works. Sound good? Let's jump in. Where do we even start? With something beautifully simple. Damodaran tells us that in this entire complicated world of finance, with its endless models and fancy metrics, there are really just two ways to figure out what something's worth. That's it. 2. Master these, and you've got the foundation for everything else. First up, intrinsic valuation. Picture an apple tree in your backyard. You want to know what it's worth? Well, you could count up all the apples it'll produce this year, next year, and way into the future. Of course, you'd have to think about what could go wrong. Maybe there's a drought. Maybe pests show up. Naturally, apples you might get 10 years from now feel less certain, less valuable than the ones you can grab today. Intrinsic valuation works exactly like this. It says any asset, whether it's a company, a stock, or a building, is worth the cash it's going to generate over time, adjusted for how uncertain we are about actually getting that cash. Simple, right? Lots of cash, delivered reliably? That's valuable. Little cash, delivered uncertainly? Not so much. This approach looks at what's actually inside the asset itself. Second, relative valuation. Back to your apple tree. Instead of counting future apples, you could just peek over the fence. Your neighbor sold a similar tree last week for $1,000. Someone down the street got $1,100 for theirs. You figure yours is probably worth somewhere around there too. That's relative valuation. You're not examining the tree itself. You're checking out what similar trees are selling for nearby. When you hear people say a stock trades at 8 times earnings, while others in the same industry go for 12 times earnings, that's this approach in action. It's basically playing the comparison game. Now, some investors are purists. They insist only intrinsic value matters, because markets go crazy, and comparing yourself to your neighbors is pointless. Others say intrinsic value is just theoretical nonsense, and all that matters is what someone else will actually pay. But Damodaran takes a smarter, more balanced approach. Why pick sides? The sharpest investors use both. They hunt for companies that look like bargains, based on their own money-making potential, and are also priced lower than similar companies. It's like finding that perfect apple tree you know will produce fruit for decades, and discovering it's on sale for half what every other tree costs. That's where you find real deals. Before we can start putting prices on companies, we need the right tools. Damodaran calls these the power tools of the trade, and they're the foundation you absolutely need to understand. First and most important, time is money. $1 in your hand today beats $1 promised to you next year. Why? 3 basic reasons you'd rather enjoy your money now than wait. Inflation will chip away at that dollar's buying power. And promises can be broken. There's always a risk you won't actually get that future dollar. Figuring out exactly how much less a future dollar is worth right now is called discounting. The rate we use captures our impatience, inflation, and that risk factor. This tool lets us compare money arriving at different times, which is absolutely essential for intrinsic valuation. Second tool, understanding risk. When you invest in a company like Disney, you're exposed to all sorts of uncertainty. Maybe their next movie crushes it. Maybe it bombs. That's Disney-specific risk. Then there are industry-wide risks, like changes in how people watch entertainment. And finally, there are huge economic risks, like recessions or interest rate spikes, that hit pretty much everyone. Here's where it gets interesting. Back in the 1950s, an economist named Harry Markowitz made a breakthrough discovery. He figured out that if you own a big basket of different stocks, those company-specific risks, the hits and misses, mostly cancel each other out. For every unlucky company, there's a lucky one. The only risk that sticks around, the one that really matters when you're diversified, is that big, market-wide risk. Finance folks have a name for how exposed a company is to this market risk. Beta. A beta of 1 means the company moves with the market. Higher than 1? More volatile. Lower? More stable. This beta helps us figure out the discount rate for valuing a company's future cash. Riskier companies with higher betas get higher discount rates, making their future cash worth less today. Third tool, basic accounting knowledge. You don't need to become an accountant, but you need to understand what the financial statements are saying. There are 3 key documents. The balance sheet shows a snapshot, what the company owns on one side, and how it paid for everything through debt or owner money on the other. The income statement tells the performance story over time, starting with sales and subtracting costs to reach final profit. And the cash flow statement shows exactly where cash came from and where it went. Damodaran introduces a brilliant idea. Think beyond the regular balance sheet and imagine a financial balance sheet. On one side, you've got the value of assets already in place, the stuff already making money, but underneath that, you've got growth assets, which represent all the future investments the company's expected to make. A young, innovative company might have barely any assets in place, but tons of value and growth potential. A mature, established company is the opposite. This framework helps us see that a company's value comes from both what it has now and what it's expected to build later. With these tools in hand, understanding time value, how risk works, and reading financial statements, we're ready to value our first company. We'll start where all value begins, with an intrinsic valuation of a solid, established business. Damodaran uses 3M, the company behind Post-it notes and tons of industrial products, as an example. When doing intrinsic valuation, our first big decision is whether to value the whole business, called enterprise value, or just the piece belonging to shareholders, the equity value. If we value the whole business, we forecast cash flows the entire company generates before paying any debts. We discount those using a blended cost that includes both debt and equity, called the cost of capital. Once we have the total business value, we subtract the debt, and what's left is equity value. Alternatively, we can value equity directly. Here we forecast cash flows left for shareholders after debt payments, called free cash flow to equity. We discount these at the cost of equity, the return shareholders demand, given the stock's risk. Done properly, both methods should give you roughly the same answer per share. So what do we need? 4 key ingredients. First, the cash flows. We need to estimate how much cash the business generates. Start with operating income, subtract taxes, then, and this is crucial, subtract money the company needs to reinvest to keep growing. This reinvestment might be building factories or developing products. What's left is free cash flow to the firm, the cash available to owners and lenders without hurting growth prospects. Second, the growth rate. How fast will these cash flows grow? We can't just guess. The most reliable way is looking at two things: how much a company reinvests and what return it earns on those investments. Simple formula: growth rate equals reinvestment rate times return on capital. A company reinvesting tons but earning poor returns creates little value. One, reinvesting wisely in high-return projects, value soars. Third, the risk. We capture this in our discount rate, the cost of capital. As discussed, this is a weighted average of the cost of debt, the interest rate adjusted for tax savings, and cost of equity determined by the company's beta. For a company like 3M, operating in many businesses, Damodaran calculates a custom beta by averaging the betas of each sector it's in. This gives a much more accurate risk picture than just looking at past stock price swings. Finally, the terminal value. We can't forecast cash flows forever, that's just impractical. So we typically forecast 5 or 10 years, then estimate what the company will be worth at that point. This terminal value often represents a huge chunk of total value. The most common approach assumes that after high growth, the company settles into stable, perpetual growth, a rate that can't exceed overall economic growth. We use a simple formula to calculate the value of all cash flows from that point forward. Putting it together for 3M in 2008, Damodaran projects cash flows for 5 years, calculates a terminal value based on stable 3% growth, and discounts everything back to the present using the cost of capital. After adding 3M's cash and subtracting debt, he arrived at about $87 per share. The stock was trading at $80. This suggested slight undervaluation, but the difference was small enough to be within the margin of error. Crucial lesson: valuation gives you a reference point, not a crystal ball prediction. Now let's switch gears and look at company life cycles, because valuing a young, hungry startup is completely different from valuing a mature giant. This is where Damodaran's framework really shines, guiding us from cradle to grave in business terms. Let's start at the very beginning with young growth companies. Think of Groupon in its first year. Exciting idea, some revenue, but also hemorrhaging money. How do you value a company with no profits and almost no history? This is the valuation perfect storm. The past tells you nothing, the future's a giant question mark. Many of these companies won't even survive. This is where valuation becomes more art than science. The company's story becomes everything. We shift focus from what the company is to what it could become. Damodaran gives us 3 value drivers to focus on. First, revenue growth. We need to estimate the total potential market for the product. Then make a realistic guess at what market share this little company could capture. For a solar panel company like Evergreen Solar, his example, this means estimating the entire future alternative energy market. Second, target margins. The company's losing money today, but to have value, it must make money eventually. We look at profit margins earned by larger, established companies in the same business and assume our young company will, if successful, eventually reach similar margins. We map out a pathway to profitability. And third, survival. This is the harsh reality. Most startups fail. We can't ignore this. Damodaran suggests a 2-step approach. First, value the company assuming it survives and succeeds. Then, estimate the probability of failure using historical data for similar startups. The final value is weighted: value in success times probability of success, plus value in failure, often 0 for equity holders, times probability of failure. For Evergreen Solar, assuming a 33% chance of failure, drop the estimated value per share from 63 cents down to just 42 cents. Sobering but necessary. What happens when a young company survives and enters high growth? It becomes a growth company. Think of Google after its IPO or Under Armour challenging Nike. These companies have real revenues and profits now. But the big question becomes, how long can they keep up this incredible growth? The key challenge is what Damodaran calls scalable growth. A company that grew 80% annually for 5 years is now much bigger. It's simply harder for a giant to grow at the same percentage as a small player. Plus, success attracts competition, trying to eat into growth. When valuing growth companies, we can't just project past growth into the future. We build in declining growth rates over time. As the company scales up, and competition intensifies. The second value driver for growth companies is sustainable margins. When Under Armour launched its unique microfiber apparel, it had a niche and high margins. But success brought giants like Nike and Adidas with competing products. The investor question is whether the company has a strong enough competitive edge, a powerful brand, unique technology, loyal customers, to protect margins as it grows. A company sacrificing margins to keep growing isn't creating as much value as one that grows while keeping profits healthy. This is what Damodaran means by quality growth. Growth by itself isn't always good. Growth only adds value if the company earns returns on investments higher than its cost of capital. A company growing through bad investments can actually destroy value. For a growth company to be a great investment, it needs high growth and high-quality growth. After years of rapid expansion, even the most successful growth companies eventually mature. They become the Coca-Colas and Hormels of the world. They've been around forever, growth has slowed to match the overall economy, and they have long, stable histories. Valuing them should be easy, right? Not exactly. The biggest challenge in valuing mature companies, Damodaran warns, is complacency. It's easy to assume the company will always be run the way it's been run. But what if it's not being run optimally? What if there's hidden value waiting to be unlocked? This is where Damodaran introduces a fascinating concept he calls valuation Viagra. He identifies 3 areas where mature companies might have slack that, if addressed, could boost value. First is operating slack. Is the company managing existing assets as efficiently as possible? Could it cut costs, improve productivity, or sell underperforming divisions? For firms earning returns on capital lower than their cost of capital, improving efficiency can create huge value surges. Second is financial slack. Many mature companies are super conservative financially. They carry very little debt. But debt, used wisely, is a powerful tool. Because interest payments are tax-deductible, debt is cheaper than equity financing. By taking on more optimal debt levels, a company can lower its overall cost of capital, which increases the present value of future cash flows. Damodaran shows how Hormel Foods, with very low debt, could significantly increase value per share by borrowing more and moving closer to optimal debt ratios. The third slack source comes from non-operating assets, particularly large cash balances. A huge pile of cash sitting in low-interest accounts isn't creating much value. In fact, if investors worry management will waste that cash on foolish acquisitions, they might value that cash at less than $1. In these cases, returning cash to shareholders through dividends or buybacks can powerfully increase value. The ultimate question is whether management will actually make these changes. Damodaran proposes a powerful framework. First, calculate the status quo value, assuming the company continues as is. Then calculate optimal value, assuming all slack is removed and the company runs perfectly. The difference is the value of control, what a better management team could create. Stock price should reflect a weighted average of these two, based on the probability management will actually change. A company with entrenched, underperforming management and no takeover chance trades closer to status quo value. But a poorly managed company with activist investors knocking might see its price rise, reflecting the possibility of value-creating changes. Finally, we reach the last life cycle stage, declining companies. These are firms whose best days are behind them. Think Sears, once dominating retail but steadily losing ground for years, or General Motors in 2009 on bankruptcy's brink. Valuing these companies is a delicate balancing act. On one hand, you've got shrinking revenues and falling profits. On the other, these firms often need little reinvestment, meaning they can sometimes pay out huge cash amounts to investors. The key question is whether the decline is temporary and reversible, or a permanent slide into oblivion. For firms that are declining and distressed, meaning they have so much debt they might not make payments, we need a special approach. This is where Damodaran's distress valuation framework becomes so useful. We use a two-step process again. First, value the company as a going concern. Assume it somehow pulls through, restructures, and recovers. This gives us upside value. Second, estimate the likelihood of distress. We can use the company's bond rating to get statistical default probability. Then ask, if the company fails, what happens? Assets get sold in a distress sale, likely for pennies on the dollar. We estimate these distress sale proceeds. Final company value is a probability-weighted outcome. For Las Vegas Sands during the 2008 crisis, Damodaran calculated going concern value over $8 per share. But with 28% default probability, where equity holders get nothing, the distress-adjusted value dropped under $6 per share. It's a stark reminder that investing in declining or distressed companies means betting on survival. Beyond the corporate life cycle, Damodaran also tours special valuation situations where standard rules need adjustment. Take financial service companies like banks and insurance firms. Trying to value a bank like a manufacturing company is a disaster. For a company like Ford, debt finances factory building. For a bank, debt, in the form of customer deposits, is its raw material used to create products, which are loans. The lines blur. Furthermore, concepts like capital expenditures and working capital, central to calculating cash flow for regular companies, are almost meaningless for banks. So what do? Fall back on the simplest, most reliable models. Value the equity directly. Often use the dividend discount model. For a regulated bank, dividends honestly measure cash returnable to shareholders. Key value drivers for banks are ability to earn high return on equity, the amount of equity required for regulatory reasons, and investment riskiness. A bank generating high return on equity without reckless risks creates immense shareholder value. What about cyclical and commodity companies? An automaker like Toyota or oil giant like ExxonMobil. Their fortunes tie to forces beyond their control, the ups and downs of the global economy or volatile oil prices. Earnings swing wildly year to year. Valuing Toyota at an economic boom peak when it's making record profits gives a very different number than at a recession bottom when it might lose money. The solution is normalization. Look past the cycle extremes and ask, what would this company's earnings be in a normal year? Average its profit margins over an entire economic cycle, say 10 years, and apply that average margin to current revenues. This gives a much more stable, reliable measure of true earning power. For a commodity company like Exxon, value it based on normalized oil prices, again perhaps using long-term averages. This removes cycle noise and lets us see underlying business value. Finally, we have one of the most important and challenging modern economy categories: companies with intangible assets. Think of technology companies like Google, pharmaceutical firms like Amgen, or consumer brands like Coca-Cola. Their most valuable assets aren't factories or machines. They're invisible: brand names, patents, technological know-how, and brilliant employees. Here we run into a major accounting problem. When a manufacturing company builds a factory, accountants rightly treat it as capital expense, an investment generating benefits for years. But when Amgen spends billions on research and development to discover new drugs, accountants treat it as regular operating expense, like paying the electricity bill. This is a huge distortion. It understates the company's true earnings and makes it look like it has far less invested capital than it really does. Damodaran's solution is bold but logical. We fix the accounting ourselves. We must capitalize these intangible investments. For R&D, treat it as capital expense and create a research asset on the balance sheet. Then amortize it over the years it's expected to generate benefits. When we do this, we get a much truer picture of company profitability and reinvestment for growth. For Amgen, Damodaran shows that capitalizing R&D expenses increases estimated value per share from about $44 to nearly $63. That's a massive difference, and it comes from simply treating an investment as an investment. This journey through valuation, from simplest truths to most complex cases, leaves us with profound understanding. Value is not a mystery. It's a story, a narrative about a company's future. And like any good story, it has key elements: the cash it can generate, the growth it can achieve, and the risks it will face. Learning the language of valuation lets you read that story, question it, and ultimately write your own chapter as a more informed, confident, and successful investor. As we close the little book of valuation, it's worth pausing to reflect on the most powerful lesson. And it's not a formula or spreadsheet, it's a mindset. What Aswath Damodaran does so brilliantly is democratize a field long shrouded in mystique. He pulls back the curtain and shows us that valuation isn't about finding a single, precise, correct number. The pursuit of precision, he argues, is a fool's errand in a world filled with uncertainty. Instead, valuation is about crafting a narrative. When you value a company, you're telling a story about its future. You're making assumptions about growth, profitability, and its place in the world. The numbers in your valuation are simply the language you use to tell that story. The real power isn't in the final number you arrive at, but in the discipline it imposes on your thinking. It forces you to ask the right questions. Can this company really grow that fast for that long? Are its profit margins sustainable? What are the biggest risks it faces? This is a profound shift from how most people think about investing. We often get caught up in the noise, the daily stock market chatter, the hot tips, the overnight success stories. Damodaran calls us back to fundamentals. He reminds us that behind every stock price is a real business, with real assets, real employees, and real capacity to generate cash. Price can dance around wildly based on market mood and sentiment, but value is the anchor. It's the center of gravity to which price will eventually return. So how can you start applying this today? You don't need to build a complex financial model. Start simply. Pick a company you admire. Could be Apple, Nike, Starbucks, or even a smaller company you follow. Just try to tell its value story. Ask yourself. First, what is its key to generating cash? Is it a powerful brand allowing premium prices? A unique technology no one else can replicate? Or incredible efficiency letting it sell cheaper than anyone else? Second, where will its future growth come from? Selling more existing products, expanding into new countries, or inventing entirely new product categories? Be realistic. And third, what's the biggest risk it faces? A new competitor? Technology change? Shift in customer tastes? Just thinking through these three questions puts you light years ahead of the average investor. You'll start seeing companies not just as ticker symbols, but as living, breathing organisms with strengths, weaknesses, and a story to tell. That was a summary of the Little Book of Valuation by Aswath Damodaran. We've journeyed through the core principles today, but I'll be honest. A summary is like looking at a postcard of the Grand Canyon. It shows you the view, but can't replace the experience of standing on the edge yourself. The real magic of this book is how Damodaran explains things with such clarity and patience. If any part of our conversation sparked your curiosity, if you felt a little thrill at the idea of decoding the business world, then I truly encourage you to pick up a copy. Reading it isn't just learning, it's an empowering experience that can fundamentally change how you see money, business, and your own financial future. Also, if you found this summary valuable and you're excited to explore another life-changing book from the Billionaire's Bookshelf, please take a moment to like this video and subscribe to the channel. It's the best way to make sure you don't miss our next adventure. Let's keep learning and keep growing together.